So welcome to everyone to our LNG sector panel. Again, just before we came live, we were discussing how on one hand we're missing the aspect of the physical conferences, but on the other hand, modern technology brings us the opportunity to connect top panelists from all over the world, as well as top delegates. And indeed, here we have today people who are logging in from Vancouver, from London, from Athens, from Oslo. We're delighted to have you with us. And LNG has been receiving a lot of attention lately. Jorgen is going to moderate the panel. Thank you, DNB, for being the partner of this conference and for shouldering the heavy lifting with us. And thank you to each one of you for being on the panel. And the floor is yours.
Thank you very much, Niklas, and welcome to this panel, everyone listening in. With us today, just to run through everyone, we have Tony Lauritzen, CEO of Dynagas LNG Partners, Oyestein Kalleklev, CEO of Flex LNG, Mark Kremin, President and CEO of the Teekay Tankers, or Teekay Gas Group, sorry, and Mr. Tarek Souki, Executive Vice President of Tellurian and President of Tellurian Trading UK. And also Christos, Economou, founder of TMS Cardiff Gas. So with that, I think I'll just kick off with a little backdrop to where we are. LNG prices, they have been on a downward trajectory for the past years since the Asian LNG price peaked at $12 per MMBTU during the winter of 2017-18. This has had detrimental effects on the LNG shipping markets, especially maybe this summer, as the economics for transportation of long-haul LNG cargoes out of the new liquefaction capacity in the US to Asia disappeared. Eventually, stocks filled up in Europe and several cargoes were canceled during the summer as LNG prices in Asia troughed even below $2 per MMBTU. So markets were all of a sudden flush with supply of gas and facing demand destructions, you can argue first from trade war and then COVID-19. But since the summer and now, both improving fundamentals and regular seasonality have since lifted gas prices and again opened up for shipping economics. And we believe we should be facing better times from here on out. However, recent markets over the past years seem to have left investors somewhat skeptical to the prospects of LNG shipping markets going forward. And we hope today's panel can shed some light on what's going on and what we can hope for in the next months and years. So just to start off straight away, tackling the big questions, I think we'll look on the demand side. And as an analyst and talking to investors, I get the perception that sustainability is getting an increasing important standing among investors. And some questions are regarding LNG as well. Most estimates say that you've reached peak coal demand, maybe as early as 2013-14. Peak oil demand on some estimates might even have been last year. And then the question is LNG. Is LNG still a good sort of transitional fuel going forward? And do investors have anything to fear in terms of long-term prospects of transporting LNG, which is also a fossil fuel? So I'll leave the floor open to the first one to pick up the mic.
I'm happy to start, I guess, just briefly, and I won't take a lot of time. But Teekay agrees with you about on the oil side. Our understanding is that it's if it hasn't peaked already, it's going to go pretty slowly over the next 20 or so years to 2040. As for LNG, our understanding is very different. When we look at the scenarios, we see it growing under under any scenario through 2040. So about 4 times faster than oil. And that includes, even if the Paris Agreement is met, we see that LNG grows. That's not necessarily the case even for natural gas, non-liquefied gas. LNG has a special place. It's not merely a transition. It's not a short bridging fuel. It's here for the foreseeable future. And just before I just add in a couple extremes to that, if we look at ExxonMobil, our understanding of ExxonMobil is that they're going to say, they say that peak oil is not going to happen until 2040, and even coal is not going to significantly soften by then. On the other side of the coin, you see DNB saying that peak energy will occur in 2030. But our view, looking at the IEA and others, is that LNG is going to be here under any scenario through 2040 at least.
Right. Anyone would like to add, Oyestein?
I think we agree with Mark, and of course, in a scenario where you are doing a rapid decarbonization, the best way to do this is pricing of carbon, and if you are going to do rapid decarbonization, the easiest and quickest and most economical way of doing that is replacing coal with natural gas. You are reducing your CO2 by at least half, and then you also get a lot of other benefits. So of course, when Europe started switching out coal and replacing it with natural gas, it was because you wanted to get rid of pollution, air pollution, acid rain. So you get all these benefits in addition, and also the fact that LNG is very cheap these days, so it doesn't really cost a lot to do this. And so if you look at the BP Energy Week, they have some projections, and even in a rapid decarbonization scenario, you are doubling the LNG market by 2035, and actually it goes quicker with decarbonization than business as usual scenario. And then once you're getting a bit longer and the hydrogen technology matures and becomes more economically, we will probably also be starting doing more carbon capture, and that's why we also had a big section on carbon capture in our Investor Day in February. It's because eventually, of course, it's not sufficient to reduce the CO2 emission by half. You have to get it down to zero. And if you pull out the carbon from the CH4 molecule, you basically are at the hydrogen level. So then you can capture carbon as a gas and store it underground, or you can capture it in solid state like hydrogen pyrolysis and actually reuse the carbon. So we definitely think we will have a lot of growth, and eventually also it will become not only the bridge, but it will also be the destination by using carbon capture.
All right, thanks. So you mentioned Europe there. Just some background. From 2018 to 2019, Europe saw LNG imports increase a massive 67% year on year. While perhaps the Asian momentum was not as large as that. And coupled with everything and trying to understand the economics behind the switch, and primarily it was the gas to coal switch in Europe which drove this sort of demand. And how does that look if you look to China or other Asian economies? Are they starting to move in the same direction and subsidizing this sort of coal to gas switch? Because on a like-for-like basis, it just easily economically doesn't make sense unless you start to price, as you're saying, carbon in this respect. Is that something you're seeing happening now in Asia, or is Asia sort of losing its interest in gas, would you say? You can start if you like, Tony.
Yeah, sure. Thank you. No, I don't think that China is losing ground. I think that what we saw with this increase in European imports was largely a result of the COVID the situation. I think that since then China has picked up the slack. They are importing a lot of LNG. They will continue to do so. And when it comes to, this coal to gas switch, I think that also China has done a very good job. You mentioned that coal peaked in 2013-14. And prior to that, you saw that, China was consuming a lot of coal. After that, the consumption of coal in China has been relatively stable. Now, they haven't decreased it, but it's stable. Had they been increasing at the pace that they were doing prior to 13-14, we would have seen a net increase of coal consumption worldwide, I think. So I think that China has done a good job. More is required. They are putting the incentives or the pressure to switch over to gas, but China is a huge economy. It's a huge economy. They need reliable and stable power. Of course, renewables are part of that equation, but it's easier to rely, for example, on gas, versus many small renewable plants. So we think, that China is on the right track. They've started importing again, and we will see this continuation of coal to gas, or at least a significant increase in LNG consumption or LNG imports to China.
So the willingness to pay for
that, Jorgen, if that's okay.
Yes.
Last time around in 2018, we saw a large increase of Chinese imports of LNG. That was tied heavily to the capacity they had as storage and also import capacity. So we see both those actually increasing over the next 2-3 years, and starting actually from 2020, 21, 22. So both those indicators should allow the country in itself to improve on the importing of LNG, because they have the infrastructure to do so. Don't forget that this is an infrastructure business in many ways and forms. Now, obviously, the coal to gas switch has been taking place. Shell famously had a slide that you would see the change in the actual pollution in Beijing, which back in, I don't know, maybe 2017 was one of the most, or anyways, a polluted city. A heavy coal to gas switch was almost proportionally and linearly correlated to cleaner air. So I think both those fundamentals should play over the next couple of years in the country's import and energy mix. And also, their 5-year plan has actually, as a country, clearly shown that should continue.
And so what would be sort of the long-term price outlook for LNG landed in Asia and the willingness to pay for that? Are we seeing any infrastructure limitations that might hamper with the price of landed LNG in Asia? I know Tellurian, for instance, has a business model where they're aiming at providing Asia with LNG at maybe $5.5 per MMBTU. What's your view on that, Tarek? Where will the willingness for gas to pay for gas be in Asia going forward?
You're watching the gas market start to correlate across the world, and you're seeing this whole thing commoditize on a global basis, which didn't exist before, right? And this is something that we've been talking about for 5 or 6 years, and it was a question of when, not if, the gas market was going to commoditize. And now, as it's happening, you really have to look at what is your cost of infrastructure to deliver LNG to the market, and then your cost of receiving infrastructure. And you'll have some volatility in market prices along the way, but in order to amortize a new facility as you're growing in this industry, you have to have a certain price. And I think somewhere around, I will say about $6 landed in Asia, you will have gas at the source, you will have your infrastructure costs amortized, and you will have your shipping component taken care of at long-term charter rates, and you will have your LNG receiving infrastructure also paid for, and then you go on to the local market, which will take care of the local market infrastructure. But $6 landed in Asia, I think, gives a small return to equity shareholders and is a reasonable price for long-term LNG. And we're starting to see, those prices start to materialize for January and February this year after a long hiatus of not coming anywhere near that. So I think somewhere in the $6 to $8 range long-term is a reasonable place where shareholders make a return, and people don't pay, the $12 to $15 to $20 that we saw in sort of the post-Fukushima world, and the sort of super frothy part of the gas market evolution. So I think $6 to $8 landed in Asia is a nice medium place to be, where you build new infrastructure and the price signals are there.
I'd say that doesn't sound, at least maybe in the lower end, but that doesn't sound too far off of what Qatar is doing on their 10% Brent-linked volume contract that was recently announced. So I guess that's a good starting point. I don't know if you have any input to that, if that's sustainable also for additional volumes, or if that's something that they're just doing to renew contracts at current facilities.
I mean, in a $40 Brent environment, I don't see how 10% is sustainable. And that is not a price signal that tells you to build, and it doesn't even make sense for gas to be priced on oil anymore. It really doesn't. It's its own commodity, and they are more decoupled in the short term. I mean, we've seen gas prices completely volatile over the last 12 to 18 months, and oil has been, you know, plodding along between 40 and 45. Maybe hit 50.
And they. Yeah, and the Henry Hub price is also definitely on the rise in the US, and I think that indicates that at least prices in Asia need to come up if you want to see those marginal volumes headed the long haul. So it's definitely something that's shaping the markets a bit more, the Henry Hub pricing effect. You saw exports out of the US had 77 liftings in January and was down to below 30 in July. So that was an illustration of the markets being full on gas. And now the question is, do you believe that with the current outlook for gas prices in the US, will there be enough production to fuel all the export facilities in the US and see high utilization and much volume moving all the long haul to Asia? Anyone can answer if you'd like, Mark.
Sure. Just to go back, we obviously didn't rehearse with Tarek, but I absolutely agree with him on the $6 plus or so, and it kind of plays into this where we're at with the 77 liftings. If you look back at the pricing from Asia, for instance, I think you mentioned it was 12 or so a few years ago, but right before that it was 7. And it'll go up and down, and it'll have volatile swings. But the main thing is the arbitrage, and at $6 or above, it's there to do the deal, because the Henry Hub has been slowly trending. It hasn't moved much at all. It's moved from low $2 to high $2. So this thesis is something I 100% agree with. If you look in the near term about the 77, or the very recent term on the 77 liftings, you had a lot going on. You obviously had the cancellations from COVID. They were 45 in each of January and August. Now they're down to 5 in November. Probably December they're going to be 0, I think. We'll see in about a week. We had hurricanes. We had Hurricane Laura shutting down some Cameron. We had a number of things going on, which I don't think are going to necessarily reflect on lower liftings out of the United States going forward. I go back to his thesis of the prices are going to be lower and they're going to be decoupled, but there's going to be gas there for export for sure.
Yeah, great.
Yeah, and I would like to add to that, if that's okay, Jorgen.
Go ahead, Christos.
So September numbers I have is 45 cargoes. In 2019, that was 48. So that's not too far off from what I would call pre-COVID levels. I don't know if the October numbers are out, but it's definitely headed in the right direction. And don't forget, you know, every market had a little bit of a bump, obviously, with what's happening today. So, you know, it's definitely headed in the right direction.
Headed in the right direction. It's another aspect that's been very typical, I'd say, for the LNGC space is that you've had a rapid development in vessel technology, and I think that's worth talking a bit about. The residual risk has been a hot topic. So we analysts, we usually generalize. So the way I see the LNGC fleet, roughly 40% steam turbine, 40% diesel electric, and then 15% or so modern last generation 2-stroke vessels. So in terms of engine technology, I guess we're rather close. We're full circle, you can say. You're back to the same technology that you use in bulkers and oil carriers. So essentially what's been used for a long time. But then on containment technology, you've had a massive improvement on the boil-off rate. So one question is, how much better can that get? And also the size aspect of the vessels, which has grown from 120 to above 170 and maybe towards 200 cubic meters in capacity. How big can vessels get? So I guess the question is how much more technological development can you see basis the rapid development that has been? I don't know if you'd like to start on that, Tony.
Yeah, sure. Thank you. Look, I think you're right. We are close to, actually in LNG, maybe we're a little bit more than full circle, because the propulsion on the LNG side is with the gas injection, which we don't have on the tankers and bulkers. So there's been a little bit more evolution there. But in terms of efficiency, we're full circle. Where we are at the moment, there is nothing new propulsion-wise in the horizon. Of course, there are. I mean, people talk about gas turbines to be used running on tri-fuel, etc. This is something a little bit forward looking. I don't think you can go and order a vessel like that today. So I think the most interesting aspect of it is exactly the size. We've seen, as you said, a tremendous evolution in size from 128,000 cube up to 200,000 cubic meters. Today, when we exclude the Qatari vessels are very particular, and I think that they've had some challenges in the past when it comes to compatibility. So when we look at optimal size, optimal containment, I think you have to look at operational restrictions such as terminal compatibility. That's very important. It's important that your vessel can trade across the world, that it can deliver, cargoes to the far, to the far edges of the world. In Dynagas, we've always been very concerned about that. For example, in general, our fleet has the ability to operate as conventional carriers or in icebound areas, which kind of widen the market a little bit for us. We did actually go out on the private side and ordered 200,000 cubic meters. And in particular, we were looking at restrictions like terminal compatibility and the Panama Canal. We were thinking that, going forward, when we see, what will all of these 174,000 cubic meters orders be used for? And we believe it's a good long haul ship, more than kind of, short haul. So when we analyze that, further, we realized that, well, if we as Dynagas are going to focus on the, on the long haul market and be part of that, let's build the ultimate long haul ship. So we sized it up to 200,000 cubic, which can go through the Panama Canal, and you will have a, a very good terminal compatibility. Of course, going through the Panama Canal, you can go above 200,000 cubic meters. The problem then is that the LOA of the vessel becomes above 300 meters, and that is normally quite a big restriction on the terminal side. That vessel is not for all trades, it's for the long haul trade. It's a great ship for the long haul trade. So I really believe that, the worldwide fleet should and is consisting of different sizes, different technology to serve different trades.
Yeah, and is it just in simple terms? Would you say the rapid technological development within this segment is put behind us, or is it to expect a similar trend going forward?
I think it's largely put behind us. I think it's largely put behind us. How much more money can you save from going from 0.05 boil off to 0.03? Right. I mean, of course, you can go all the way to net 0% boil off if you just have, a thick enough containment system and a high enough, and a good enough capacity reliq plant. But, it's all, as you say, a cost question, and, and you do need energy to run the ships. You do need energy just to idle the ships as well. So it's, it's to find the right, design for you.
And I think what's important to note also is that, as you said in the beginning, or and Tony correctly also pointed out, but the two-stroke engine is used on the majority, supermajority, probably maybe 95 to 98% of the whole worldwide shipping fleet, excluding LNG. So this is an engine that people are very familiar with. So people talk about technology as a concept. However, this is a proven industrial engine for many years and generations. So there's not much you can do there, as Tony correctly said.
Yeah.
So on the vessel side, I think Tarek might have some insight. But as you probably know as well, once you order many ships between 160 and 174s, a lot of the SPAs probably get written with those margin or top-ups in consideration. So that becomes your, let's say, in the tanker trade, which maybe Mark is a little bit more familiar with, that becomes your workhorse, your Aframax. So once you have that established, then it's kind of difficult to really change the dynamics because your whole infrastructure is based on that. So what Tony's saying is great and nice. However, and it's nice that he has the ice class ships for the 2 terminals that take them, but it's not, doesn't mean that that's going to be the trade in itself. So there are going to be one-offs, of course, in any trade and in any market. But if you have now 200 ships that are going to be ordered 174s, and maybe roughly, and I don't have the exact number, but let's say 160s to 155s or another 200, that's pretty much the trade there. So maybe that question is Tarek's to answer.
I think we'll need to leave it at that. We need to get on a bit, but we'll touch a bit more on it, I think, later. But just a quick question to Oyestein. The gas prices have not been moving in the right direction. They've been headed downward more or less the past 3 years. And I guess that reflects a bit in the advantage of having top-notch vessels and modern vessels in service. It hasn't really been reflected as much of a advantage in the freight rates achieved for those vessels so far. Is that sort of a valid explanation, would you say, Oyestein? And if gas prices are to pick up, you'd think that would go back out?
I think in general, of course, gas prices have rallied from the bottom now. So TTF prices in Europe was $1 and JKM was 1.8. Now TTF is 480 and JKM is 550. So we are approaching more normal gas prices. And keep in mind, if you're going to $6 to $8, it's pretty cheap. You're talking on equivalent to oil, $35, $45 for LNG, which is a cleaner fuel. So I think prices at these levels are quite attractive for the consumer. In terms of our ships, of course, they are basically spending half the fuel of our old steamship, and then our parcel size is like 25-30% bigger. So we save a lot on the fuel savings. Of course, we save more when gas prices are higher. So of course, then you can command a bigger premium, because what we are doing is consuming a bit of the cargo every day in order to propel the vessel. And then if you're consuming less, you have more to sell at discharge port. But it's also another aspect of consuming less fuel, and that's the environmental credentials. So a lot of energy companies these days are becoming more concerned about emissions, and the good thing with the two-stroke engines, of course, much more efficient engine, as Tony explained. You have a thermal efficiency above 50%, which is more or less like similar to our combined cycle gas power plants. So emissions are much less, and they are much less than the four-stroke when it comes to methane slip, because methane slip on a mega ship is marginal. It's very, very limited, 0.35 grams per kilowatt hour. And then on the XDF, it's basically reduced 50% compared to a tri-fuel. So if, if you are in Shell and BP and, the major, super major these days, you are also getting measured not only on financial metrics, but also on environmental metrics. And you will have a target plan for emission reduction, which is tied to a management incentive plan. So of course, people are very incentivized also to go for the newer ships, also because of environmental credential, not only economics. So if you look at the spreads today, so Fearnleys came out with the market assessment report yesterday, tri-fuels, 70 to 74,000 depending on basin, and the premium on our ships is still $10,000, $12,000 even in a low gas price environment. because they are more efficient, and these are the ships people want.
I think that that's a good layup to the next question, which is there are a lot of contracts or vessels that have been on contracts that are rolling off at the moment, both steam and also some diesel electric vessels. And I think what a lot of people are questioning is what are those vessels going to do? And now that they're rolling off contract,
me, I don't have any.
No, it will be directed. So, but it's. So the question is, what are they going to do, and which direction are second-hand values going? Is it's proving difficult to close deals on second-hand vessels coming off contract, and are charterers willing to take them on? What do you feel from the charter side in that respect? I don't know if you'd like to start, Christos.
Sure. Well, okay. The 174s, so our company has 11 174s on long-term contracts. Now we have another company that we manage their vessels that have TFDs. And obviously we see the market. We just fixed the Chinese cargo, for argument's sake, for around 4 months at 60,000. So that's a TFD. So whoever wants to put a premium on Flex, that's great. Maybe it's what Oyestein says. I don't know. However, the real market on the 160s is there is a market there. It was built on the Pacific trade rather than the Atlantic trade. So there's definitely a market for the TFDs. Now, obviously, for some trades, as Oyestein has correctly said, the 174 cargo lot is what the customer needs. Doesn't mean they want that ship for every cargo that they have. Obviously, if the cargo that they have is a 160, then the differential becomes a lot more competitive. So yes, I agree that the new ships are definitely, the new 174 ships definitely are what you would call, or in my mind, the US Panamax. But the 160s definitely have their own market, and that's going to be, they're not going to disappear, if that's what you're alluding to. These ships are built to last. So they're just going to be a smaller, they're going to become a smaller part of the trade. So, if you see the numbers, and I think that's important, the delivered XDFs and Meggies, so every delivered two-stroke ship is 80. That's 80 ships in the water. That's what I have anyways. So the total fleet is 600. So it's a very small percentage of the actual fleet. So I would not jump to conclusions that this is the greatest thing that ever happened. Of course, it's a very important technological change, but the TFDs are going to be around. Maybe on a discount, but they're going to be around.
Yeah, if I may, from a charterer's perspective.
Exactly.
And this might go back to Christos's earlier question too, right? A lot of the contracts are written where you have a range in how much volume you're going to deliver. And I will tell you that in some of the market that we've had this summer, you wanted to be on the low end of that range, right? Because if you did not want to have to fill up a ship and buy a bunch of volume that you're going to then lose a bunch of money on the other side. So you're going to go narrow that range. And as much as I think that the 200s that Tony are building are quite sexy, actually. But when, so if you have a long-term, long-haul contract that you want to fill that's a great ship for that kind of thing. But as you've got 30% of the LNG market now on spot trade, and that number is going up every year, by the way. You need to have a combination of your bigger, more efficient ships along with your smaller, a little bit more flexible, maybe if you can get them cheaper, for the one-off voyages. Those are important too. So I think having the right mix of portfolio is going to be very important for somebody that's going to be trading a mix of long-term and short-term trade.
Yeah.
I mean, so a crappy steamship if you can get the right price for, a single trade for a short distance.
Exactly. So, but then further on to that, in terms of the duration of the contracts that you're seeing in the market, we can start with Tarek, but if any of you others would like to chime in on what the majors and such are discussing in terms of charter length, the market has definitely been thin, and the market has been at rock bottom, but in terms of long-term contracts, what sort of duration are we looking at? And I don't know if you have any view on that, Tarek. How long would you take a vessel on?
Hard to say where I sit today. I will have to see what the makeup of my portfolio looks like when when we start to build our project out and we start to sell volumes down the line. The concern you have now is a lot of contracts are going, sort of 6 years or less. I'd say 2/3 of the contracts that were signed this year follow that pattern, with 1/3 being over that, and of that, only maybe 10 to 15% were sort of in the 15-year range. So, the LNG infrastructure market, like the shipping market, is going to have to adapt to these shorter tenors, which doesn't mean that you're not going to sell to that customer for a very long time. It's just, some of the pricing is going to get re-rated. You're going to have to be a little bit more creative on how you manage your portfolio, and you're going to have to really optimize every aspect of what you're doing. And look, there's precedent for it in every other commodity that went through a sort of growing into a commodity phase to a mature commodity phase. I mean, oil went through this in the 40s, 50s, through to the 70s, and by the 90s, it was a completely mature market with all the financial instruments that go through it. Gas is getting to that point, right? So we are going through that commoditization phase, and it's going to require a lot of optimization and a lot more management, and your spreads and your margins aren't going to be as big as they used to be. So you have to be a lot more diligent in the management of your portfolio.
Yeah, and what about methane slip as an aspect to chartering in, the second generation diesel electric? Is that something that you're getting a lot of feedback on from the majors, for instance? Is that becoming an increasing part of the discussion in chartering?
I can just speak to that briefly, and it may be contrary to what the others are seeing, but we actually haven't seen so much of that. We've seen the majors being more concentrated on fuel use in general, and it's largely because of cost rather than the emissions. And when it comes to the emissions, it's obviously been pretty much CO2. So if we bear in mind, in fact, if you look at most of the orders are XDF, and they actually have a higher methane slip than MEGI. So I'm not sure how much the majors have been compelled by that. The methane slip, just to be clear, is only about 0.5% or so of greenhouse gases. And so we actually are in favor, at least Teekay, of more reporting to the IMO. So we can highlight that. It's not a huge factor. It hasn't been a huge factor, but we're happy to speak to it, frankly.
I totally agree with Mark.
Good. Okay, so headed on to the equity markets a bit more. It's been a tough time to be a publicly listed LNG company in terms of the pricing that you're achieving in the market. It's putting a limitation, I guess, to how easy it is to print equity to fund fleet growth, at least, and that could be a positive in terms of the supply and demand balance. What can you do, and it also relates to a question that we got in, what can you do to restore the investors' interest in investing in this segment going forward, and what should they be aware of that they might be missing? Anyone can start. We have 2 minutes left, so we need to be short.
Continue to deliver good results. I think is the most important, being honest, transparent, and for us, it's been building stone by stone, and we took delivery of our 10th ship here on Wednesday. We've been increasing our backlog incrementally as we have been adding ships on the water. So it's basically being a bit patient there. LNG market and the growth is a long story, with a lot of growth ahead of us.
Yeah. Anyone like to add?
I think what Oyestein said is very true. LNG is a long-term game. The reward will come later. I mean, for example, in the case of DLNG, we are prioritizing to reduce the debt levels now. We think that's a good use of proceeds when the market cap is small, and you can build equity value going forward by significantly reducing your debt levels. So there are many avenues, but as Oyestein said, it's a long-term game.
All right. So thank you very much. We're out of time. It's been a pleasure discussing with you, and thanks so much for your time, and to the audience for listening in.
It's been a great panel, very well attended, and you guys had.
Thank you. Good to see everyone.
Thank you to everybody. I
Okay,
look forward to having you with us.
Have a nice day.
Thank you so much.
Thank you.